Today, we're diving into Axon Enterprise, ticker symbol Axon, a stock that has seen a dramatic pullback recently and is now catching a lot of investor attention. As of April 10th, 2026, Axon is trading at around $345.94. That's down about 16% just this week, roughly 35% over the past month, an eye-catching 60% drop from its 52-week high of $885.92. So naturally, the big question is, what's going on here? And is this a buying opportunity or a warning sign? Let's break it all down. First, let's talk about why the stock has dropped and how it has been performing recently. The recent decline is not driven by a single factor, but rather a combination of legal concerns, profitability issues, and shifting investor sentiment. One major overhang is legal uncertainty. Axon is currently dealing with concerns around a $1.3 billion headquarters project in Arizona. A court hearing tied to this project has raised questions about future spending commitments and potential liabilities, which investors generally don't like. On top of that, while the company is still growing quickly, profitability took a hit. In Q4 2025, revenue grew an impressive 39% year over year to about $797 million. However, net income dropped sharply to just $3 million, compared to $135 million a year earlier. That's largely due to aggressive investments in AI, acquisitions, and overall expansion. We're also seeing analysts becoming more cautious in the short term. Major firms like Bank of America and RBC Capital have cut their price targets recently, signaling a shift in sentiment, even if they're not outright bearish. And finally, insider selling has added to the pressure. When executives and directors sell shares, it can reinforce concerns that the stock may have previously run ahead of its fundamentals. Now, if you're new to the company, let's quickly cover what Axon actually does. Axon is essentially building what it calls a public safety operating system. It's best known for its taser devices and body cameras used by law enforcement agencies. But the real growth story is in its software ecosystem. Its cloud platform, Evidence.com, allows agencies to store, manage, and analyze digital evidence. This creates a recurring revenue model, which investors tend to value highly. More recently, Axon has been pushing heavily into AI. One of its flagship tools, Draft One, uses generative AI to automatically create police reports from body camera audio. That's a huge potential efficiency gain for law enforcement. The company is also expanding into adjacent areas like emergency dispatch systems, drones, and even private sector security solutions. So overall, it's evolving from a hardware company into a full-stack public safety technology platform. Next, let's look at analyst price targets. Despite the recent sell-off, analysts remain surprisingly bullish on the long-term outlook. The average 12-month price target is around $729, which implies significant upside from current levels. Estimates range from about $570 on the low end to over $1,050 on the high end. Looking further out, some long-term models suggest the stock could reach around $900 by 2027 and even as high as $2,400 by 2030, assuming AI-driven growth really scales. So clearly, the long-term story is still intact in the eyes of many analysts. Now let's talk about valuation, because this is where things get interesting. Axon used a trade at extremely high multiples. At its peak, the price-to-sales ratio was close to 30 times. Now, it has fallen below 10 times sales, which is a significant compression. Similarly, the forward price-to-earnings ratio was once around 130x, but is now closer to 76x based on 2026 estimates. That's still expensive compared to broader market, but for a company growing revenue at over 30% with software gross margins above 80%, some investors would argue it's justified. So the valuation has come down a lot, but it's not exactly cheap. Now, the big question, is this a good buying opportunity? Personally, I think this would be an attractive entry point for long-term investors who believe in the company's vision. There's a growing consensus that this might be a by the dip scenario. Some major institutions, including Morgan Stanley and Goldman Sachs, have suggested that the recent sell-off is driven more by non-fundamental factors rather than a breakdown in the business itself. Another strong point is the company's backlog. Axon has about $14.4 billion in contracted bookings, which provides strong revenue visibility for years to come. However, in the short term, the stock could remain volatile. Technical indicators are still bearish, and there may be resistance around the $480 level. So this might not be a straight line up. It could take time to recover. Now let's go over the key risks, because there are definitely some important ones to consider. First, AI regulation is a real concern. New laws, such as California's SB 524, require disclosure when reports are generated using AI. This could slow down adoption or add compliance costs. Second, margin pressure is something to watch closely. The company is spending heavily on research and development, and stock-based compensation is expected to be between $590 million and $620 million in 2026. That could continue to weigh on profitability. Third, international expansion may not be as smooth as expected. Data sovereignty laws in Europe and competition from local players could limit growth outside the U.S. And finally, the stock's premium valuation means it's more sensitive to any negative surprises. Before we wrap up, here are a few additional things investors should keep in mind. Management has set ambitious targets, aiming for $6 billion in annual revenue and a 28% adjusted EBITDA margin by 2028. The company has also taken steps to simplify its capital structure by redeeming convertible notes due in 2027, which is a positive sign. Looking ahead, the next major catalyst will likely be the upcoming earnings report, especially any updates on AI product adoption and the resolution of the headquarters legal situation. So overall, Axon remains a high-growth, high-potential company, but it comes with meaningful risks and short-term uncertainty. If you believe in the long-term story, this pullback could be an opportunity. But if you're more risk-averse, it might make sense to wait for more clarity. Thanks for watching. If you found this video helpful, please like and subscribe to the channel for more stock analysis and investing insights.